Hey, welcome back to another video. If you're thinking about buying a home, or if you're already in the process, you probably know that it's a huge financial decision. What most people don't realize is that the price that you see online is just the beginning. There are a ton of hidden costs that are going to sneak up on you and seriously impact your budget. In this video, I'm going to break down all of those overlooked expenses that come with buying a home, things like inspection fees, lender charges, HOA costs, moving expenses, and even the appliances that you think are going to come with the home, but they don't. I'm going to break it all down, and I'm going to show you exactly what some of these hidden costs are so that you feel super confident when moving forward on your dream home. Let's get into the video. First up will be hidden lender fees. So when you first talk to a lender, you're going to want to ask for a cost sheet. And you're going to want to make sure that during the transaction and 100% definitely before closing that you compare it, but even other times throughout like the transaction, like if you lock your rate or if you have changes in credits or purchase price, you're going to want to make sure that you're referring to the original cost sheet to some updated cost sheets that you're going to get throughout the process. You're going to want to stay up to date on things like cash to close, credits, but you're also going to get a cost sheet the first time so that the first time you talk to a lender, you know what the costs are, you know that nothing is changing over time, nothing is going up, nothing is getting changed since you guys originally spoke. This is going to tell you the things as, cost of things such as the appraisal, the title policy, the origination fee, interest rate, total cash to close. This is going to give you a really good estimated breakdown of what your total cash to close and cost is going to be to buy this house. So if you do decide to shop with multiple lenders, this is going to be a very important document that you send around to different banks so that they can help compare it to what they're going to offer you. So the first thing to be aware of would be any hidden lender fees. You're going to want to make sure that to avoid this, at all costs, you get a cost sheet from the first time you speak to a lender. That way nothing can change, and then you're going to be constantly referencing this. You and your agent will be constantly referencing this original cost sheet to the settlement sheet, to other cost sheets and updates throughout the transaction to make sure that nothing is getting slipped in there or changed over time. Next up would be any realtor fee or commission fees. So I don't think it's a secret that realtors are going to get paid. And they get paid most oftentimes, typically they get paid a percentage of the commission upon successfully closing. So it's not an hourly rate, it's not a salary. Typically they don't get the check until you get the keys. And at least that's been the most common way of compensation to real estate agents for as long as time can tell. You can honestly compensate a real estate agent however you would like, as long as it's in agreement. There's some type of agreement, a compensation agreement in place between the agent and the buyer. Honestly, as long as that's in place, they could be compensated anyway, but typically it is a percentage of the sales price in the form of a commission when the home closes. I want to talk about this a little bit more because you might have heard about this recently. As of August 24, there's been some things that are put in place that require any licensed real estate agent anywhere in the United States to get some disclosures in place before opening doors or negotiating on your behalf and really stepping into that role of representation. There are a few ways to go about this, and I'll let your agent be the one to explain it to you. However, I'll tell you that for me and my business, nothing has changed. Honestly, if it's anything, it's helped buyers because it's brought more transparency to the market. It's weeded out bad agents or people that just wouldn't or couldn't do what is required to do now. Aside from agents being required to get these disclosures in place, nothing has changed. Sellers have never been obligated or forced to pay any type of commission to buyer's agents. It's always been very customary and standard, which it still is till today. We'll talk about some more. But if anything now, the change, it just requires agents to remind their clients that their compensation agreement is between the buyer and the agent. It's never been between the agent and the seller. So it's reminding buyers, hey, listen, our compensation is between me and you. However, it's very, very customary. In I would say every market across the US, it is very customary that a seller compensate a buyer's agent 2 to 3% of that purchase price. Very, very customary. And I've had dozens of closings since this changed. I've had dozens, and I have yet to run into one seller who is not willing to pay a commission, nor have been paid by my own buyer. You're gonna wanna hire an agent who fights for every single dollar. They're gonna wanna treat your money like it's their money. You don't wanna hire someone who ends up turning this into a cost for you. It's very, very common for me and my clients when we're scheduling tours. I'm already asking sellers, hey, are you guys offering a co-op fee? How much is that gonna be? You know, I'm poking them and getting some questions out of them, because when my clients are walking through the house, they already know that if they make an offer, this is not gonna be a cost, because it's gonna be covered by the seller. So who you hire really matters. And if you've got any more questions about this, I would love to sit down, explain it more, or just provide some more insight on this overall change. Now, I feel like not a lot of agents are going to clarify or just very make clear of the out-of-pocket costs that might go with buying a home. And there's not many, but there are some out-of-pocket costs that if you don't end up buying a home, you're going to be out this money. So you're going to have that general home inspection that's going to be paid out of pocket at the time of the inspection to the inspector. This is going to be anywhere from about $300 to $800, depending on the size and the type of the property. Then you're going to have a termite inspection or a pest inspection. This is going to be anywhere from about $75 to $100, just depending on the property type and all of that. And then you've got a roof inspection. Those are typically free. I'd recommend getting at least 2 because they can be very subjective. And then you've got other ones. You've got sewer, HVAC, windows. You can really get an inspector for anything. But what's typical would be a home, a roof, and a pest inspection. If the home inspector goes in there and he indicates that there's an older HVAC, or maybe there's a concern with the plumbing, maybe some drainage issues, they can recommend that it get looked at more in depth by a professional in that field. The inspector is going to typically note if any other systems need further evaluation. So things like the fireplace, the sewer, the HVAC, even mold, he could look at and say, hey, I might recommend that you get somebody in here. Mold, radon, those are all options that are available. They're not super common, but you can opt for them. Those prices or costs are going to run a little bit higher the more involved that inspection is. I'd say typically though, my buyers are spending about $400 to $500 out of pocket on home and pest inspection. Roof is free, and if there's anything after that, HVAC, sewer, plumbing, stuff like that, it could add. But it all depends on the size and the type of the home. The price of the home is typically a correlation of the price of the home inspection. So it's not really based on price, it's more based on size, but the larger the home, typically the more expensive those inspections will be. This one's a good one because I really don't hear a lot of people talk about it. This is gonna be a 50% deposit, or a deposit for when you're building a new home. So there's a couple ways that this happens. When you're building a new home from the ground up, there's gonna be a series of payments that you're gonna make throughout the course of the build. The first payment is going to be due at the signing of contract. This is going to be considered your earnest money deposit, and we'll talk about earnest money a little bit later. But this is going to be anywhere from about 3 to 10% of the purchase price, and it's typically non-refundable. There's going to be some certain stipulations in the contract, finance, appraisal, contingencies, where it would be, but typically it's non-refundable. And it's going to go towards your total cash due when you close. So after you make that payment, if you're doing a build from the ground up, you're most likely going to get some type of upgrades, right? You're going to have a structural upgrade, you're going to have interior cosmetic upgrades, and most builders are going to do one of 2 things. They're going to have a threshold that you can spend without having to put any additional money down. So an example would be, you could spend 10% of the base price or less and select anything that you want. Anything after that, anything 11% more, 10% or more of the base price, we want a dollar for dollar deposit or down payment, additional down payment. So that's what could happen. You could put that money up front when you sign, you could go to the design center, you could pick out your options. If you're under that threshold, there is a good chance that you don't owe any more deposits up front. But if you are above that threshold, you could expect to have to put some type of deposit down. The other way builders could do it, and this is a little bit more common, is that they would want 50% of the total cost of design upgrades. So for example, if you put $50,000 in upgrades between structural and cosmetic and all of that, if you put $50,000 in upgrades, they would ask that you put down an additional $25K deposit to be added to your closing. So it would be added to your original deposit. It would be applied to your closing cost. If you go to closing and if you have more money in deposits, then say that your original deposit and this deposit are more than what you need for your cash to close, you will get it refunded back to you. So they're not going to take extra money or anything like that. But maybe you're putting 3% down and you're having the builder contribute some building costs. But just for the sake of it being the case, any money that's left over that is not needed, it's going to be refunded back to you at closing. So after those 2 deposits are done, say that they're both needed, your initial deposit when you sign and your deposit for upgrades, there is a chance that you might need some more funds due at closing. So then at that point, when you go to sign and get the keys, you would need to bring a check or do a wire to complete the rest of the funds. So in that situation, there's going to be anywhere from 2 to 3 points of deposit where you're going to have to submit that money to them. All right, I wanted to take a minute and pause the video right here. What's been the biggest hidden expense that you did not expect? Drop it down below. I'll pause it. All right, we're getting into the video. We've got earnest money. So this is not really a cost, but it's going to be an amount of money that you need to put up front in the first 24 to 48 hours of contract acceptance. It's negotiated as part of the offer, and it's either going to be refunded back to you or it's going to go to the overall cash needed at closing. So unless you breach the contract, which we'll talk about some more, it's really just good faith money. It sits in escrow for the length of the transaction, and it basically just shows the seller that you're committed to moving forward. There's going to be certain contingencies in the contract that make this money refundable, but overall, this money is going to either go to your total figure at closing or be refunded back to you. Or if for some reason you breach the contract and do not perform on the purchase or some other terms of the contract, you could potentially have this money be jeopardized and forgave to the seller. So that's something to keep in mind. You really want to protect this money throughout the length of the transaction. I have never lost earnest money from my clients, and I don't ever plan on it. Earnest money is typically going to be 3 to 6% of the purchase price. In some situations where maybe you have an extended closing or you have a home to sell contingency, maybe you're even in a super competitive market, this could be negotiated as non-refundable immediately, which honestly to sellers is a very desirable thing. You've got the appraisal fee. Now, this is going to be required by most lenders on most forms of financing. There are some circumstances in which I've been party to where a lender might waive an appraisal, but it's not very often. This fee is going to be anywhere from $300 to $800 depending on the property and the bank that you use. It's very important to look at this when considering lenders, as different banks have different costs, and that's typically a buyer paid expense. If for whatever reason the appraisal is ordered, it's not able to be canceled on time, maybe you have a bad inspection, you've got to change a heart. I've seen it go both ways where you could either still owe either the half to the full amount of that appraisal, or if I've been part of some transactions where the lender just covers that expense out of their own pocket. I've also seen cases where a lender just waives the fee altogether, even if you do purchase the home, just trying to be a good sport and play a role in helping you secure a home. So that is another cost. You'll see it on your initial cost sheet that we talked about when you first talk to a lender. That'll be a fee that if you are talking to multiple banks, you're going to want to compare it. It's not going to break the bank. You're going to be within a couple $100 depending on the lender. It's just something to keep in mind. If you've got a lender with a lot of high fees, that's one of the fees to look out at. You should be between $300 to $800 depending on the property type and situation. You've got HOA fees. So these can be very significant or they can be very minor. Some HOAs have monthly dues that are hundreds of dollars a month. So it might sound reasonable, it might sound worth it. You got gyms, pools, spas, all of that, but you could have some issues at the closing table. So when you're purchasing a property with financing, the HOA cost needs to be accounted for in the payment. So this makes it a hidden expense because when you're looking at homes, when buyers are looking at homes on Zillow or realtor.com, they're not taking that into consideration. So even a $200 a month monthly payment, that can affect your buying power by almost $25,000. So, a lot of buyers might be shopping for homes on Zillow at the top of their budget, right? And they're not accounting for the fact that they also need to qualify for a payment that is $200 to $300 higher than their maxed amount. So making sure that you have a good lender and a good realtor on your team to guide you through this, walk you through different properties, explain this to you ahead of time. It's going to make sure that you're going to secure the home that you want at a price you feel good about. You're not going to keep shopping homes and missing opportunities and feeling beat, because you're going to have some pretty good guidance and some pretty good leadership of, hey, this is what we need to look for, and this is going to be the strategy that we use to get it. We've got private mortgage insurance. We're going to address the rumor here. I feel like people love it or hate it. So private mortgage insurance, it's a type of insurance policy. It's required for conventional loans, and it's when a borrower's down payment is less than 20% of the purchase price. So this is going to protect the lender. It's almost like it's an insurance. It's going to protect the lender against any financial losses on the borrower defaulting on the loan. So there's a huge debate on this, I feel like. Is it good, is it bad? At the end of the day, if it fits for you, then it fits for you. And there's no one size fits all for these types of situations. A lot of investors, a lot of people I see buying their second, third, fourth properties that I work with, they are using conventionally based loans and they're putting more than 20% down. That is pretty common. People have been saving for many years. They've gotten good bonuses from work, stocks from work. Where I see a lot of my clients win is by already owning some property. So they're either selling or cash out refinancing on that property to get some funds and use it as a down payment or use it to buy that house in cash. So that's where I really see it. But if you need to use it and if that fits your situation and that's part of the strategy to help you qualify, then that's what we're going to look at. On average, mortgage borrowers who pay PMI, they're going to pay anywhere from $30 to $70 for every 100,000. So if you take out a loan for 300,000, you put less than 20% down, you're going to be paying anywhere, you'll be up to like $200. So anywhere from, depending on how much you put down, 5 to 19%, you'll be anywhere from 100 to about $200 in PMI payment. And all of it's going to depend on the rate that you qualify for. Now we've got moving costs. These aren't really often accounted for. It's the expense of actually moving into the home from one spot to another. So whether it's just down the street and you're making trips in your car and you're factoring, just the gas for moving one spot to another, or if you're actually going from one state to another and you're hiring movers and that pod thing where they drop it off and pick it up, whatever the situation is, there's going to be some type of cost to move into the home. Honestly, if it's under 50 miles, I would probably say it's pretty safe to assume that you can move for well under $1,000. Anything from state to state, you could probably be $1,000 to $3,000, just depending on how far, if you're driving, shipping a car, all of that. If you are moving across the country or into the country, that can really vary. If you're shipping 2 cars, if you're shipping 1, driving 1, you've got food, movers, hotels, it could be thousands. But these are all things to consider, all things to talk about with your realtor so that you guys can be aligned the entire time and just have a really good game plan. With me and my clients in my business, I get a ton of clients with doing YouTube. I get a ton of clients that are moving from out of town constantly. People are calling and texting me to help with that move. And, one of the things that we're able to help with is getting some seller credits or builder credits, depending on what type of purchase they get, where the seller or the builder, they can essentially cover some of their closing costs so that their cash out of pocket, it stays in their pocket. They don't have to pay some of those closing costs, and then they can put some of that money towards those moving expenses. A lot of these people are moving multiple states, they're moving everything that they have, cars, just everything, clothes, furniture. So it does pay, even if you can get the seller or builder to pay $5,000 in closing costs, that's a lot of money that's going to save you out of pocket that you can spend in $5,000 or $3,000 or $4,000 on moving expenses. So just game planning that, being aligned with your agent on that is going to make sure that you guys are being the most cost efficient in your move. You've got the fridge, the washer, and the dryer. This is often one that the buyers either never think about or they quickly forget, and it's super important to keep in mind, especially if you're going to be touring several homes. This can be a pretty big cost depending on if it's being offered or not. The stove, the microwave, the dishwasher, sinks, all of that are going to automatically convey because they're built into the kitchen. Anything built in is automatically going to convey per the contract. Now the fridge, the washer, the dryer, they typically are not built in, and they typically need to be specifically asked for in the contract, in the offer. So on the low end, this could be anywhere from $6,000. You figure $2,000 a piece, you've got about $6,000 that the seller would be offering or not offering. When you're touring homes, if you see a property that already has a washer, dryer, and a fridge, it's pretty typical to assume that those would convey. You would mention them in the contract. Although it's not always the case, it's pretty typical to assume that. If you are touring a home and you see that there's no fridge, there's no washer, no dryer, it's pretty safe to assume that it's not being offered. The one caveat to that is that in some new construction homes, they will not install the appliances until a home is under contract, until it's got a pending offer. And this could be a negotiation tool for them because they might have incentives where they say, oh, we're offering appliances. Or they might even be a part of the offer where you need to negotiate that. But typically, you either walk into a new construction and they either already have it and they're already offering it, or you don't see it and it's something that you can negotiate with. But typically, that's just something that you want to be aware of. If you are buying a home, you want to make sure, are they supplying a fridge, a washer, and dryer, or do you need to buy that on your own? Because that could be anywhere from a $5,000 to $10,000, $15,000 cost for you. And last but not least would be HOA transfer fees and overall fees with the HOA. There are just a smaller detail of a contract, but they can get super overlooked. If there's any fee that is most negotiated, in my opinion, it's going to be this one. It can go both ways. When asking the seller to cover this, it could work or it could not work. That's going to be a combo for a later time. It just really depends on the situation and the property and kind of where that offer's at. But regardless, it's a fee that, well, I mean, hopefully it's never hidden from you, but it's just not as widely talked about. So these can be anything from a transfer fee, it could be a capital improvement fee, it could be an assessment fee. In PA, the HOA transfer fee does not have a cap. However, it's pretty common that it's between $200 to $500. So this would be considered a closing cost that's paid at title through closing. However, it is negotiated between the buyer or the seller on who pays that. It could even be split where it's 50-50, which is, I would say, maybe more common than one or the other. And that's a wrap on all of the hidden costs of buying a home. I know it can feel super overwhelming, but the more you know, the better prepared you're gonna be. And that's how you're gonna make a smart, confident decision when you're in that position. It's also super important who you hire. If you found this video helpful, make sure to hit that like button, subscribe to the channel so you help out our content, and then hit that bell so that you never miss a video. I'm gonna upload tips, insider tricks, lifestyle content. So if you ever have any questions or just want to talk about your own home buying journey, drop a comment or even shoot me a message. I'm always here to help. Thanks for watching, and I'll see you around the neighborhood.